Welcome traders, freetradingvideos.com, the best place on the internet for trading education. If you're not a member, you better become one. Information on this site is hot. So, big sell-off in the markets today, way down, and we need to recover. One thing I want to point out to you tonight is if you're short this market, a couple things you need to be looking at that is showing risk on the downside that this market could bounce. First thing would be the bank. Here's the support resistance area in the bank. This is at many videos back, we looked at the 2310 area as an area where the Fed was very active. And again today we pushed right back above that 2310 area. If we go to the 5-minute chart here, you'll see a huge surge in the bank today. And look at this, just a massive surge. Now we actually trade and close above the open, which is just phenomenal, absolutely phenomenal. Fed was extremely active. Plunge protection team is extremely active in turning this market around this afternoon, and that created short covers, and market moves up. One thing I want to point out, that's one reason why you've got to be careful here. Bank bouncing off that support area on the daily chart. Second reason, VIX over 50. I mean, this is just crazy stuff where this VIX is right now. VIX over 50 is, all-time high. Unbelievable stuff. Absolutely unbelievable stuff. This could signify a bottom. Now, it may not come tomorrow, but it has the potential, has a greater probability of taking place. So, one thing to look at. Another one to look at. Another good point that really shows interesting data that shows market bottoms is when we get new lows, basically over 600. We've had many days in the markets where we've had new lows over 600, but I have never ever seen new lows in New York Stock Exchange at 1850. Never. That is extreme. So this is another reason that the market can bottom here. So be careful. If this market bottoms, we're going to have one huge short cover rally. Now I'm talking short-term bottom, not talking long-term bottom. It's very rare to get a V bottom in the market. In other words, a market that comes straight down, comes straight back up. We usually need to retest the lows before going back up, or at least produce a higher swing low before going higher. So this could signify a bottom here. Bottoms do take a long time to develop, just like the top took a long time to develop in 2007. If you go back to the bear market of 0203 area, you'll see how long it took for that bottom to develop. Okay, we can see here, here's 2002. You see down we go, higher swing low back up, down test again, sideways consolidation for many months, down we go and test again. So before moving higher, we finally get out of this range here, and that's where you really load up and go long, is breaking it out of that range. So this is one formation that may happen here for the market to bottom. You can see, there's July of 2002. We finally break out of that range. Like, that's May of 2003. So nearly a year process to put that bottom in. Very similar to the top that developed in 2007 to break down to where we currently are in these market environments. Very safe in these markets. Be very careful. If you're not an experienced trader, please be in cash and do not play in these market environments. Capital preservation is the #1 for my trading business. Until next time, breakout out.